Welcome back to another episode of Tank Talks. I'm your host, Matt Cohen. And on today's episode, we dive into the world of family office investing with Ron Shon from REDDS Capital. Ron shares his early life growing up in Japan and watching his father travel to Canada to develop his real estate empire known as the Shon Group, a family legacy since 1954, into one of Vancouver's largest landlords. We get Ron to share the insights on how education from Stanford and Wharton shaped his vision for building a global business in North America, and how the sudden passing of his father a week after graduating Stanford forced Ron into taking over the family empire. Next, Ron explains how he was able to shift from real estate to technology and VC investments after luckily investing in Apple stock on a whim, while realizing the cap potential of real estate investing when going up against pension funds and institutional investors. Lastly, Ron discusses how REDDS Capital assesses potential startup investments and shares how they provide not just capital, but also strategic advice and network support to foster innovation and growth in their portfolio companies. But before we jump into this week's interview with Ron Shon, we welcome back to the tank John Ruffalo to discuss the news and stories making headlines in the tech and venture capital ecosystem. Welcome back to the show, John. I want to get your thoughts on something that I listened to this week. I'm not sure if you caught the Acquired podcast with legendary investor Charlie Munger, who is almost 100 years old, who gave his honest opinions on many topics, but one of them was on venture capitalists. And as he quotes, "To hell with them. You don't want to make money by screwing your investors, and that's what a lot of venture capitalists do. Quote, you really shouldn't be in the business of charging extra unless you are really going to achieve unusual results." So he took a swipe at a couple personalities in the business as well. And obviously he did compliment some people in the industry, saying how, Sequoia Capital is one of the greatest venture funds, American investment firms of all time. I just wondered your thoughts on this. What would you say to Charlie Munger about the VC industry if you were having dinner with him? Is he right? Does he have a point?
I would say that, first of all, I'm a huge fan of Charlie Munger. And if for those of you who have followed him, he does have a way with words, and he does go to the extremes on purpose in order to make his point. But I think his point is a valid point. To me, what the real point, and by the way, many entrepreneurs will have heard this from me when I say, hey, you are a very good business, but you are not a venture fundable business. And what I really meant by that is not a disservice, but rather, what are you doing? It is the most expensive form of financing, and there's so many other things that you should consider, perhaps, before getting to venture capital financing. And the value of it is that if there is a time clock, you would need that capital in order to produce an advantage, so be it. But I think that the comment that I would say to a lot of entrepreneurs is think about all of the ways on how to build your business. And the best way is to build it off the back of your customers who have a vested interest in your survival and using that cash flow. So he is right. And the last thing I would just simply say is, and I do joke about this a little bit, but when venture capitalists too come out and go, we have value add, what do you really mean by that? And when you really see that, and I will readily admit, there is a perverse, inverse relationship between the amount of time that I have spent with the most successful outcomes of my portfolio. What does that really say? And I would say that if you stratify your portfolios to A's, B's, and C's, a good venture capitalist could impact a B and save them perhaps from going down or getting a little bit of an extra return. But no VC is saving a C in their portfolio, and they're not really adding much to the A.
Yeah, I 100% agree. I'd say the work we spend on, the bottom 50% to make sure that they are successful enough so that it creates, a capital return is way more than the ones that are top 10% in the portfolio or top A's for sure. But I think what Charlie was really pointing fingers at was sort of the egregious fees that some funds are charging, the 3% plus 30% carry.
He was pointing to one firm in particular on that one. Yes.
Yeah. And speaking of that firm, Mr. Horowitz and Mr. Andreessen, they just came out saying that they are targeting a $3.4 billion next core early stage fund and seed stage fund. I'm shocked as well, which is a slight increase from their prior funds, which is crazy in this market. But one interesting part that I picked up on that I'd like your thoughts on is they're not requiring, but they are asking limited partners to invest via a new master vehicle that would feed into sub funds, including some of their sector specific funds like the gaming fund. There is another fund that did this. It was Sequoia as well, but theirs was not voluntary. So what are your thoughts on this?
This is not really for the benefit of the LPs. This is for the benefit of the general partner or the fund. I guess if they could get away with it, good for them. Sequoia executed this and it was a complete disaster where you're right. They were not allowing you to make the choices. Here's the problem. There is the generalist funds and then there's the highly specialized. These are two great firms, outstanding firms that started from the specialized and now are kind of moving more into this generalist fund. Large capital pools, what they do is they like to say, I want to invest, let me do the diversification. You are the best at this. If I wanted the best gaming, it's not going to be your fund. Or if I want the best crypto, it's not necessarily going to be your fund. And I would rather do the diversification. So you're not really saving me anything when I put it into a master and then you're doing the asset allocation. That's my job as a capital allocator, is what I would say. But firms like a Sequoia and Andreessen could get away with it, I guess, because so many people are lining up, to be their investors. But I actually don't think it's ultimately good for the industry.
Yeah, it's they become a fund to fund for themselves. And so I think the LPs are kind of passing over the workload to them and it does make their jobs a lot easier for sure, because they can just go to their trustees and say, look, we're diversified, but we only had to kind of due diligence one firm and they took over the risk and delegated the funds accordingly. But I don't think that's the right way. Maybe LP should be thinking about it long term. So we'll see if they end up hitting that target. It would be the only firm that increased, I think, as of late.
I was an investor in them when I was at Omer's. I'm a big fan of theirs. The only comment I have, and again, it's a little bit unjustified, but do they have a little bit of shiny new object syndrome at Andreessen? And when I say that, they had the crypto fund, they had the gaming fund, etc. By having a master fund, does it actually accelerate the shiny new object syndrome so that they can be very quick and flexible to move monies wherever they think is the hottest area? But there's not a natural tension from LPs to say, wait a minute, that's a real shiny new object. Stop chasing that. And we don't like for you to chase that. So I do wonder, is it because Andreessen, might be better in their asset allocation? Or is it the capital pool? And maybe they're really, you're right, they're really outsourcing the capital allocation decision away from the capital pools.
Yeah, I think that it's a bit of herd mentality from the LP side, just saying, I'm not going to lose my job by investing in Andreessen versus taking the risk on somebody else on a very special general or non-generalist specialized fund. Talking about, red shiny objects or so, there's obviously a lot of money still going into new AI platforms, but there's also a lot of money being burned in a lot of companies as of late with all of AI. The healthcare automation company that was once valued at $4 billion had sold itself off into pieces, to Waystar and Humana Health. And so that company had raised nearly $900 million from Vista Equity, Dragoneer, General Catalyst, Sequoia, some of the best in the business, and once valued at $4 billion. I guess the question is, a lot of people were trying to do these rescue rounds in Q4, which we're halfway through now, and it doesn't seem like it's working out, like the convoy we spoke about the other week. I feel like Q1 is going to be a really bad quarter for these growth equity companies that could not do rescue financing. I've heard from some people that not only are they not getting rescue financing, but some of these companies that were sitting on hundreds of millions of dollars of invested capital were basically depleted on that, but also sitting with 50 to 100 million of mezz debt at the high teens rates, paying $1 million a month alone in interest. So how bad is Q1 going to really be?
I thought we were going to get through this side, and Q4 was going to be a fantastic time to do some of the transactions. I will tell you from our perspective, we've been looking at a lot of those. When you look at the underlying businesses, there was two problems that we were seeing. Oh, actually, maybe three problems. We couldn't get excited on the future business. It was an overhyped business, and the market is just not in their favor. That was number one. Number two, on the unit economics, it was going to take so much money to fix it, and you're going through a RIF and all the severances you required, and we start running the math and go, Jesus, it's not leaving very much to go to the business in order to enable the business to get the right unit economics. And the third, and this is the most troubling part, and I'm still frustrated, people are still worried about dilution. And they have broken cap tables at valuations that were so egregious, and they somehow think that, maybe with the business turning around, we've been predicting a technical recession in Canada. We think we're in it now, perhaps mildly. It's only going to get worse. But that last example is the one that frustrates me, in that, dudes, you don't go bankrupt by having cash on your balance sheet. Don't worry about the dilution. You did something, you could fix it, at least if you're the employees. If it's the investors, hey, investors, tough luck. That was the game that you're in, and you're going to get crammed out. But that's the game that we're in. So I say in Canada, that has been a particularly acute issue that I still find surprising.
It is surprising. When we look at dilution, we forecast aggressive dilution on a worst case scenario across all of our investments. When we model them out to an exit enterprise value, minimum 50%, all the way up to 75% on the dilution side, which you should do as an early stage investor. So you should be backfilling your entry price and your starting ownership to know if you have to take on, let's say, 75% dilution by the end of it, the value, enterprise exit value, is still worth a lot to your fund overall. And I don't think a lot of people do that. A lot of people also, they only look at the dilution on the pref side. They don't take into ESOP and the common shares and all the other grants and other things like that out there that really trickle down when 100% of the business is transferred to the acquiring.
The only other question I would have too, and again, this is more a question mark, are they mismanaging their reserves as well?
For sure. For sure.
So that's a big issue, right? So for those of you who don't understand, the issue is that the earlier you go, you typically try to figure out how much capital over the course of time, and it's a bit of an art, is going to be required. And what you really want to do is you want to be able to double down all the way through, and it enables you to calculate how much money is reserved for that particular portfolio company. And the earlier you go, the reserve is a multiple of your first investment. And then as time goes on, you start adjusting it through, and it's a tough exercise, but that's part of portfolio management. What I find happens in a number of these cases, the shit hits the fan, cap table is broken, and a lot of the insiders, and this is to your question, say, I'm tapped out, no new capital's coming in. Where are you in helping your own portfolio company, and did you mismanage your own reserves, and now that portfolio company goes away? So that would be a question for me to really unpack.
Yeah. Another question I have is, how do you think reserves are being played when you see deals like Google committing $2 billion to Anthropic, rival OpenAI? Were the early stage investors willing to buy their pro rata on that valuation? I doubt it. Where you got that. And then you got Mistral, founded by former Meta platform and Alphabet researchers, looking to raise $300 million. Now we know these large multi-hundred or, double-digit billion-dollar rounds are not pure primary rounds, right? I think a lot of them has to do with purchasing of NVIDIA devices, chipsets, and things like that. There's a lot of like hard costs that are going into these financing rounds, but it is interesting, like the amount of money that Lightspeed and Google and NVIDIA and Amazon are throwing into these large language model companies. Well, why would you even be an investor in these rounds as an early or as a growth investor? Like, I just don't understand the point, because then they're going to gobble up the business if it fails, because they're the largest shareholder and they probably get rights to own the assets. And if it works out, how much more are they really going to be buying their minority investors out for? I just don't see it.
Say is on a Google, even if Anthropic doesn't have the exit, which math would suggest, it's going to have to be $20 billion, or actually,
right.
What was the pre-money value? It was $20 billion, right?
Yeah, I mean, Google committed $2 billion to Anthropic.
And $200 billion.
200.
So it's $200 billion exit in venture land is what the expectation of that would be. However, Google's, is using this for marketing, learning, getting chipsets, maybe bringing those employees back. And there's so much other strategic value drivers. I still think that's pretty pricey that a purely financial investor can't do. So I agree with you. On a number of those, I think it makes it very tough. And if you're in Canada, where we have much smaller pools, it really takes out any Canadian involvement.
Yeah, I was speaking with a VC, a very well-known VC the other day, and they said they did a study on how, if any generational companies were created during previous hype cycles, by looking at the investments made by that. And the answer is no. And they basically said when OpenAI was first invested and created, the hype cycle of the day was like Casper and like CPG companies, Warby Parker. Those were the hype investments at the time these companies were created. So if OpenAI or Anthropic is now the hype investment it's being invested in, that's not when they were started. That's when the hype money goes in. It's unlikely, based on what we've seen in times past, that they all automatically become a generational company.
Intriguing. So I should go out and invest in some shoes and eyewear? Is that what you're telling me now?
Yeah, essentially. What I'm telling you is, for us as early stage investors, we need to be 3 to 4 years ahead of any potential hype cycle. It's already too late for these investors, in my opinion. That's why when we invested in VoiceFlow at the 2018 time period, there was no category for conversational design. There was no real chatbot, AI software. That became the market eventually. Now, luck and good timing, sure. But I think that's the lesson that we're thinking about now from our perspective. If something is already hype with all these AI wrapper companies, it's unlikely it's going to become a generational company, is my point.
Yeah. When the Uber driver is explaining to you about Gen AI, maybe, unless that Uber driver happens to be working for Google, which you never know, you're absolutely right. It's likely too late.
You're still seeing, it's funny, in our pitch decks, we see a lot of them. We're still seeing the Uber for X still popping up.
Yeah.
Decades later, which is crazy.
I still say the Shopify for X all over the place, though.
All right, John. Till next time. Thanks again.
All right. See you, Matt.
Now let's jump into the tank for this week's episode with Ron Shon from REDDS Capital. Thanks for joining us in the tank today, Ron.
My pleasure, Matt. Nice to be here.
Ron, your journey into the real estate and investment world is one filled with legacy and community, and it's not often we have someone with such wealth of experience joining us in the tank to share your story with our audience. So maybe to kick things off, it would be great if you can give our audience a brief background on where you grew up, your upbringing as a child, and how you eventually took over the family real estate business and where it stands today.
I was born in Okinawa, Japan, my parents having moved there right after the Second World War. And I spent the first 13 years of my life in Okinawa. I went to school in the United States. I went to prep school in Connecticut. Then I went to the West Coast and attended university at Stanford. And then after that, I went to Wharton for an MBA. My parents at that time were still living in Okinawa. And what they were doing, what my dad was doing, was running a retail business. But at the same time, what he did was he traveled to Canada on a number of different occasions and started buying real estate, starting in Saskatoon, of all places, and then moved to Vancouver. Eventually, he ended up with a nice little portfolio in Western Canada, and he decided to move to Vancouver in 1977, which is the year I graduated from MBA school. Tragically, what happened was I graduated on a Sunday. He passed away the next Friday. So it was very sudden, very unexpected. So as the firstborn son, it was the expectation that I would jump in and run the family business. And so at that time, our activities were largely focused on real estate and a little bit of side investments, like we had a stock portfolio, an investment portfolio, but nothing really serious. So for many years, what we did was just concentrate on developing and building our real estate portfolio. And so over the years, we've built and been involved in a number of buildings in downtown Vancouver, up and down the west coast of the United States, in all three western provinces in Canada. And we were also involved in Toronto real estate for a little bit as well. We were involved in the United States and in Dallas, Texas for a while. No longer. I guess about 7 or 8 years ago now, we decided to make what I would call a strategic decision to look at other avenues, other investment opportunities that I thought might be more appropriate for where we were as a family office.
Oh, wow. An incredible history. I mean, your father, Charles Shon, started the Shon Group in 1954, but as you say, he didn't get to Vancouver until 1977. So was he acquiring all these assets with just like flights over from Okinawa, Japan to Canada, and then going back to Japan and letting somebody else like operate them?
Yes, that's quite right. Yeah. So we had an operator here who looked after the properties while he was gone. We were lucky because the manager was quite good. My father trusted him, and he did a very, very good job for us.
Wow, that's fantastic. So he starts the Shon Group in 1954, as you mentioned. In 1977, as you graduate your MBA from Wharton, your father passes away essentially a week later. I got to ask, did your father share any kind of words of wisdom with you throughout your time as a young adult before handing over the reins, unfortunately, at the time of his passing?
I spent a lot of time with my dad over the years. I feel very, very, very fortunate to have done so. And one thing that he kept telling me over the years was, it's really not how much money you have, it's how well you plan. Money you can make, you can lose. But if you have a good plan and you stick to the plan, chances are you will be successful. There's always going to be people who are smarter than you, who have more money than you. If you plan, you can generally outthink them. Those words of wisdom, those pearls of wisdom have stuck with me throughout the years. I haven't always abided by them, but every so often I go back and I remember what he told me and get myself back on the rails, so to speak.
Yeah, get yourself back on track. I mean, you had a good track to start with. You received your BA from Stanford University, as you mentioned, on the West Coast, and then you went to get your MBA at Wharton on the East Coast. How did those years learning from some of the world's most prestigious institutions impact your views on building a global business out of Vancouver, Canada?
Coming from Okinawa, which is a very small place, I was very sheltered. I hadn't really been exposed to too much. When I went to the school in the United States, it was like the country boy coming to the city. You know what I mean? And my eyes were opened. As I got more and more, I spent more and more time in the United States, my eyes were becoming more and more open. And even today, I live in Vancouver, which is a relatively small city on a global basis. So every time I go to New York or I go to Beijing or Shanghai, I'm just amazed at the scale of the buildings and the scale of the city. I come back home and I feel like, people in Vancouver, especially in Western Canada, just don't have a sense of scale. What I learned when I was going to school in the United States was that it's a big world, and there's a lot of smart people out there.
Yeah, absolutely. I mean, I kind of grew up, in Toronto. I went to school in the East Coast of Canada. But when I moved down to New York City, again, my eyes were open. Living there for a few years, working on Wall Street, it totally changed the way I thought about relationships, business, networking, the way, commerce was really done. It really does have a significant impact on you. So I can totally understand that. But speaking of scale, the Shon Group has owned and managed over 4 million square feet of real estate, and has developed some of the most iconic properties around the world. So maybe you can explain to our audience the approach you've been taking to structuring these types of deals for success, and maybe some highlights and stories about the deals you've done that have had a lasting impact on your career.
Yes, Matt. We've been involved in downtown, Vancouver downtown real estate for a number of years. We put together the HSBC building on Georgia Street. For those of you who know Vancouver, that building is located right across the street from the Hotel Vancouver. And then we also developed the building across the street from that, which is a building called Cathedral Place, which is at the corner of Georgia and Hornby. And so, I would say that those two buildings are, iconic. What I learned in that process, while I was going through this whole, development process, commercial development, especially office development, is a business that requires big dollars and a long-term viewpoint. And it was my experiences working on those two buildings that was the catalyst for me to start looking at other areas to invest in, to try and grow the family business.
I mean, there must have been some pretty memorable experiences or challenges, though, with those two projects with Cathedral Place and HSBC. Any ones you can share?
The site of the Cathedral Place was an old the old Georgia Medical building, which had a lot of historical significance. It was built in 1926. So when I announced that I wanted to redevelop the site, we had a lot of sort of public dissension. And there were a number of articles in the paper about wanting to keep that building as a heritage building, to preserve it. I had quite a fight with City Hall and the other people who wanted to keep the building. It was a lot of fun. We had some trying times, but at the end of the day, I achieved what I wanted to do, which was to blow up the building, which I did actually. I actually got a company in and had the building imploded. So that was quite a lot of fun. Actually, it happened on a Sunday morning at 6:00 a.m. It's kind of a tourist spectacle that day. I mean, it was.
Did you get to push the button?
No, I did not. Unfortunately, I wish I could have, but no, they wouldn't allow me to do that. Yeah, liability reasons. That I was told.
You can cut the red ribbon tape to open it, but you're not allowed to destroy it.
Exactly. Yeah. Yeah.
Your family obviously has expanded, as you mentioned, beyond real estate with investments in technology and venture capital. What initially led you to start investing in these areas, and how has your experience as an entrepreneur influenced your approach to investing in areas like venture capital?
As we spent many years developing and owning commercial real estate, office buildings, shopping centers, and that type of thing. But it became very, very obvious those kinds of buildings that we were getting involved in required a long-term view and required a lot of capital to play in that business, basically institutional. And so if you take a look at the landscape in North America, and actually probably around the world, okay, the large office buildings, the large commercial buildings are generally institutionally owned. Individuals like me just don't own them because we can't afford them. I found that increasingly my competition was people or firms like OMERS, Ontario Teachers, AIMCO. I mean, big institutional investors who have a unlimited amount of capital and a very, very long time horizon. So as an individual, I could not compete. And so I decided that in order for me to continue to achieve the above market returns that I had been used to, it would be better for me to look at other areas. Just coincidentally, at about that time, one of my investment advisors convinced me to include a few shares of Apple and Microsoft in the stock portfolio. And at that time, I knew who they were, but I didn't really know much about what they did. And so I said, okay, fine. I just said, yeah, just do it, and show me. Okay. Well, guess what? Okay, those companies started performing much better than everything else I had. And so I decided that, I better look at this seriously. And I came to the conclusion that the reason why those companies were performing much better than the other ones that I had was because they were, and still are, producing goods and services that are globally scalable. Like for example, everybody wants a smartphone. If I were to build another building on Georgia Street, who cares? Right? I mean, nobody cares, okay? But if Apple comes out with the iPhone 15, well, the whole world knows about it. What they were doing is producing products and services that were impacting the lives of people all over the world. And that's why these companies are so valuable. So what I did was I took a real hard look at the technology sector and decided that if I was to achieve the above market returns that our family had been used to, it would behoove me to spend some serious time, investing in that sector. And I did. And so we put together a group of people. We have an organization. We have a venture capital firm called REDDS Capital. We've invested in a number of startups around the world. And so that was 7 years ago now. I've learned a lot in 7 years.
Oh, I'm sure. I mean, I think the fact that you realized that, one, you were getting outcompeted by people with basically endless pools of capital, lower cost of capital, and infinite time horizons was just not a place that you wanted to be competing as an individual investor in the real estate space. So they could obviously outbid you and undercut you. But also, you realize that there were limits to how big of a market you could actually acquire, in the real estate space, which is quite intelligent. It's kind of like how you came from Okanagan and then you made your way to the big cities of the US. Your eyes were open to the global potential of these technology businesses that basically had borderless, customer bases that they can sell into. Good on you for obviously recognizing that for someone who's spent basically 100% of your life in the real estate world. So with REDDS Capital, that was started 7 years ago. Maybe explain to our audience, how that group was formed, the capital that you guys are deploying, and the primary industries or sectors that you are focusing on for investments.
As I indicated, we put together this group of people about 6 or 7 years ago now. Initially, what we did was we started investing on an individual basis in certain startups. Okay? But then we decided that we would formalize it by creating our first fund. So we did that. We have investments in 14 companies around the world. These companies are early stage companies. They are companies that all have the potential to become unicorns in a number of different areas, but the most common area, the most common theme amongst all of them is artificial intelligence. So we looked at the AI sector and decided that of all the emerging technologies that are out there, AI was probably the one that would impact the world the most in the foreseeable future. So fast forward to today, given what's happened with ChatGPT and a number of the generative AI companies that are out there, our prediction has been right. We also have an investment in a company called Analog Computation Enterprises, which is developing a new type of chip, which is an analog chip. It's a non-silicon analog chip which has the potential to change the nature of computation as we know it. And it'll be out in the market in probably 6 to 9 months.
Wow, that's incredible. And so as a general partner of REDDS Capital, how does the group assess these opportunities, and can you explain more about this open innovation venture capital model that you have working at REDDS?
The premise behind open innovation is that small companies generally innovate much better than large companies. There are a number of startups around the world doing very interesting things. Okay, most of the interesting things that are being done today are done by small companies. Very, very few large companies like Microsoft or Apple or NVIDIA come up with, really, really groundbreaking new stuff. Most of the stuff is done by, small entrepreneurs who have ideas, and they have the freedom to do what they want. So that's what we call open innovation. We look for companies, startups, who have these bright ideas, new products, new services, whatever it may be. We help them grow with the idea that they will be interesting as acquisition targets for larger companies. So that's what the open innovation model is.
And how are you helping find these acquirers? Are you working very closely with these companies, or are you leveraging other venture capital funds as lead investors to do a lot of that?
We get deals from many, many different sources. Our lead partner, a person called Stephen Ibaraki, is very well known in the startup area. He is an MVP of Microsoft and has been for a number of years, sort of globally recognized as an AI expert. And so through him, we get a lot of deal flow. 2 years ago, we looked at over 2,200 deals, 2,200, which is a lot. Obviously, most of them we just discarded. But there were a few that were very, very good. Given where we're situated, I think we're seeing some of the some very, very good stuff out there. In many respects, much earlier than even the very well-known venture capital firms in the Valley.
Yeah, no, I know Stephen. We've been on his podcast. Very, very well connected individual. Which companies in the portfolio would you say are the closest to becoming a unicorn in the near future?
Analog Computation Enterprises, ACE, is the closest. It is the one that also has the most potential.
Gotcha. And how have the returns sort of shaked out over the 7 years you've been investing capital?
We haven't had an exit yet because we didn't start investing until about 4 years ago. I think that once they start coming, I think our LPs will be very happy.
Gotcha. And so, given that you obviously have a background in real estate, how do you contribute to the broader ecosystem of innovation and entrepreneurship? And how are you also staying up to date on all the emerging trends and how the landscape is changing for your own team at REDDS?
Let me say this. Okay, I'm 70 years old, 70. Okay, so I'm an old guy. I read something a number of years ago, and what I read really stuck. Okay? Apparently, if you have an IQ of 130 and above, you can learn anything you want to learn if you put your mind to it. I know what my IQ is, and I can learn anything I want to learn if I really want to. I think it's more a question of attitude to keep up to speed with everything else or everything that's going on around the world. I read a lot. I spend a lot of time on my computers. I search out everything that's new, everything that I can that's new in certain areas of technology. And that's how I keep up to speed. I think that anybody can learn. It's not rocket science. Well, maybe it is in some ways, but no, it's. I think it's an attitudinal thing, and it's just a question of rolling up your sleeves and doing it.
Yeah, I mean, look, 70 is still young, and being able to stay motivated is the most important thing. Exactly, absorbing it all and deploying it is definitely possible. What would you say beyond financial returns, though, is your greatest hope for the impact of your investments?
One of my greatest hopes is that one of our companies actually comes through with an innovation that will change the world in a meaningful way. I think that ACE, Analog Computation Enterprises, is that company because what it has demonstrated is a new type of artificial intelligence which has the potential to solve one of the most vexing problems today in computer science. And that problem is the NP-complete problem. For those in the audience who know a little bit about computer science and mathematics, there's a very famous problem called the traveling salesman problem. And it's an optimization problem. Basically, what it is you have a salesman who has a number of different destinations that he has to go to. And so the problem is to find the most efficient way to travel to all those cities. If the traveling salesman has, let's say, 3 cities to go to, it's not a problem because you can figure it out. A human can figure it out. Maybe up to 10. But that number goes up to, let's say, 100. Even the most advanced supercomputers today would take a long, long time to figure out the answer, and what they call exponential time. In other words, as the number of cities goes up, the time that it takes to come up with that solution goes up exponentially. So what ACE has done is that it's found a way to solve that problem in polynomial time, which means an acceptable amount of time, a regular time. These NP-complete problems they're very, very common. In weather prediction, for example, I mean, ever wonder why weather prediction is so inexact? The reason is there's too many variables. Another example of an optimization problem is FedEx. FedEx has hundreds of thousands of routes every day, delivering millions of packages. And so they have a center that's been set up to optimize all their plane routes, their truck routes, courier routes, etc. Okay, but the solutions that they come up with are probably not optimal. So what ACE has done is that it's developed a new type of AI which actually optimizes that whole process. ACE is running a test case right now in the oil and gas area. It's already proven that their technology works and works very, very well. We've tested it against the existing best practices technology, optimization technologies that's out there in the oil and gas area, and it beat it by almost 17%. So it's that company is the company that we believe will have the most potential to change the world.
No, sounds very interesting. Ron, you've obviously amassed a lot of wealth over the years, mostly through real estate. How much of your net worth are you deploying or hoping to deploy into this area of investment?
At the beginning, I approached it very cautiously. I said to my family, this is not a type of investment that you would do if you mortgage your house and do it. No, it's nothing like that. Okay, you might deploy 2 to 3% of your net worth to invest in something like this. Okay, but I think that as we get better at what we do, and as we achieve our exits, which I think we will, my plan is to increase the percentage of my net worth into technology investments, because I think that potential returns there are significantly more I could ever achieve in the real estate area. And here, let me give you an example. And I've said this to my friends and my family many times. In downtown Vancouver, there's something like 27 million square feet of office space, okay, worth, my guess, maybe $30 billion Canadian. Well, ChatGPT, in their latest round of funding, and this is a company that's 6 years old, okay, their valuation was slightly over $30 billion US. So you have a situation where you have the entire downtown Vancouver, all the office space in downtown Vancouver, which took hundreds of years to develop, the involvement of millions of people, and then you have ChatGPT, 6-year-old company, now worth 40% more than all the space in downtown Vancouver. So that's the power. I mean, that's the potential of technology. It just boggles the mind. The numbers look ridiculous, but they're true.
Yeah, I think people probably would say, real estate is wealth preservation and long-term capital appreciation, where OpenAI is sort of go big or go home type of world-changing technology that could potentially be, throttled by so many other things like regulation, by changing in government habits or consumer habits. So, we could say the same about all the high-flying IPO companies that were, down 95% last year, but we're worth that as companies. So, maybe some people take the other side of that. I guess speaking of family though, Ron, you must have family that still operates in the family business of real estate. How have you explained to them about your legacy and your interest in these types of non-real estate investments? And how have you allowed them to sort of straddle both sides of the equation?
I have 4 sons. And my oldest son, who's a lawyer, securities lawyer, doesn't practice anymore. Okay, he's our fund manager, so he's very heavily involved on the technology side. My third son runs the real estate side. What I try and do is I try and keep everybody up to speed about what's going on. And I think that they all understand that diversification is important. My real estate son, for example, he sees what's happening. He sees that we cannot compete with the institutions. So we've got to find a way to leverage our time and our expertise and try and do other things. There's really been no disagreement, as long as everybody understands what's going on.
Yeah, I mean, a lot of the real estate families that are LPs in our fund think about it the same way. Generation 2 and 3, the sons and daughters are all seeing opportunities that are, coming to them from their friends in technology and startups. And the families need to figure out a plan and a process to how to vet and filter for that because it is outside of the core real estate business that they've built. And that's why they've looked at us as a partner for them to be able to filter and analyze and co-invest alongside while still getting exposure to that market without putting too much time and effort into it, even though the next generations are interested in it.
This is an interesting point you just raised. What I have done is a little bit different than, let's say, your typical LP real estate family office. Okay? Most of the family offices that I know in real estate have given their money to a third-party manager, like yourself, for example. Okay, what I did was I went one step further. I decided that I would jump in there myself. I mean, is that going to be a good decision or not? I don't know. Okay, but I think it's looking pretty good for us.
I think it's
now.
a time.
It's
thing.
A time thing. Yeah.
If you have the time and your family operations can be run by maybe your sons, then that makes perfect sense. I completely agree with that. But if you're still in the thick of it, building the family real estate business, and this is only going to be a couple percent, it may not make sense, but to each his own.
Exactly.
I got to ask, Ron, looking back at your journey, you've obviously had a lot of success. You've had a lot of probably ups and some downs, maybe. What message would you give to your sons or other future investors, the next generation of investors or entrepreneurs who are looking to go down a similar path?
Plan. Like my dad told me, just plan. Have a plan, okay, and stick to the plan.
What was your plan? Because I don't think your plan was that your father would pass away a week later. So
No. At that point in time, I really didn't have a plan. My plan, as I grew up and still is true today, is to keep the real estate going as a cash flow machine. Keep it growing on a steady basis. I mean, that's what's going to pay the bills. That's what's going to put food on the table. It's not going to be super exciting, but what it'll allow us as a family to do is to invest in these other things, these outlier things, like these technology things, which have the potential to create significant wealth. I mean, maybe more wealth than the real estate. Who knows?
Yeah, I agree. It's great. That's a great plan. And I think a lot of family offices have awoken to this sort of diversification, but also outgrowing their, kind of traditional operating business mentality and trying to kind of learn while also making investments outside of their areas of focus on a day-to-day basis, which is what you've obviously done and continue to do.
Sort of generally speaking, if I was a manufacturer of products, for example, if I owned a manufacturer, if I was not involved in the real estate area, I would look at the technology area and I would think that unless I sort of adopted the newest technologies and try and kept up with my competition, sooner or later, I wouldn't be able to compete. My feeling is that the technology train is here. It's leaving the station. Unless you jump on the station, you're going to miss out. So that's what I did. I mean, I not only did I decide to jump on the train, I didn't want to be in the caboose. I wanted to be in the first car, to be part of the group that would have a part in creating new technologies and in changing the way things are done around the world.
Yeah, I love it. 70 years young and still looking at building and investing in the next version of AI and innovation. Fantastic. Before we wrap things up, Ron, we always ask our guests for their fast favorites. So first off, your favorite podcast?
Fast Money is something that I look at, that I listen to quite a bit, because it's fast, it's interesting, it's new, anyway, I find it very interesting.
No, for sure. Next is your favorite newsletter or blog?
Yeah, actually, I don't have one.
All right. Well,
I can tell you what my favorite book is. It's a book called The Fourth Industrial Revolution.
Okay.
Which talks about the evolution of, I guess, business life over the last 200 years. It starts with the first industrial revolution, with the invention of the steam engine, and it goes into the second one, which was the invention of electricity, and then the third industrial revolution, which occurred in, say, the 1970s, with the introduction of semiconductors and the internet. And then now we're in the fourth industrial revolution with the advent of AI and machine learning. That book I found very interesting because the message is that every industrial revolution has spawned new business models.
Uh-huh.
There's a lot of that happening right now. And unless you keep up, you're going to be left behind.
Fantastic. Next is your favorite tech gadget?
Probably my iPhone.
Yeah, that makes sense.
I sleep with it pretty well, I mean, yeah.
I'm sure. And your favorite new trend?
Probably artificial intelligence.
I had a feeling.
Over the next 20 years.
I guess. And last but not least, I think I know the answer to this one, but just say it again for our audience. Your favorite life lesson?
Plan.
Always have a plan.
Have a plan. Always have a plan. Stick to it. You can always make changes. But if it's well thought out, don't deviate too much. Okay, always come back to it.
Sounds good. Wise words.
Hey everyone,
from Ron
thanks
Shon,
for tuning in to another episode of Tank Talks. We hope you found today's conversation as insightful as we did. If you're enjoying the show, we've got 3 quick things to ask of you. First, hit that subscribe button on your favorite podcast platform so you never miss an episode, whether that's Apple Podcasts, Spotify, Google Podcast, or YouTube. Next, follow us and stay up to date on upcoming episodes and behind-the-scenes content on social media with Twitter, LinkedIn, and Instagram. And lastly, share the love. If you found value in today's episode, share with a friend or colleague who'd benefit too. Your support helps us bring in more amazing guests and keeps the Tank Talks engine running. That's it for today. Until next time, keep disrupting and innovating.